Hi, and welcome to the Stock Scores Market Minutes for February 20th, 2017. This week's topic, understanding price gaps. We'll do my regular weekly market analysis and then the trade of the week on Unilever. All right, let's get into the analysis then. Understanding price gaps. A price gap occurs when the demand or supply for a stock is much different from one day to the next. So if there's exceptional demand, the stock may close one day at $10 and open the next day at $12 and never really trade in the middle. If there's excessive supply, let's say there's some bad news, you could have the stock close one day at 10 and open the following day at 7. Usually this is caused by some news released outside of market hours that changes the perception of fundamental value dramatically. What we worry about as traders is how is the market going to behave after the gap. There's a tendency for up gaps to bring out profit takers. You can imagine one day you own the stock and it's trading at 10, the next morning it's trading at 12. There's more desire to sell that stock and lock in that quick profit. And because of that, we want to make sure that we wait for a base to form before buying upward gaps. Now, I do this on an intraday basis. If I see a stock gap to the upside, I'll give it some time and wait for it to build a base to form before I actually consider that stock to be bought. Oftentimes, upward gaps will resolve with a fill of the gap where the stock moves down from the open. I'll show this in an example when we look at the trade of the week in just a moment. The upside potential is also less with up gaps because the market has priced in high expectations. And so we need to recognize that the reward for risk may not be great when you buy big gap ups. All right, let's get into this week's analysis. Here is the chart of the S&P 500 going back 30 days, 60-minute chart. You can see we had a little bit of a pullback late this week. Remember, this is an intraday chart, so pretty short term. So there's a little flag pattern, and that flag basically brought the market back to the upward trend line. We broke the flag at the end of the day on Friday, and that should lead to higher prices in the near term. Looking at the weekly chart, we see that the trend is getting a little bit parabolic to the upward, to the upside. I'm having trouble drawing my lines this week. I don't have my normal pen to do this, so I'm using my mouse. But anyway, that's a terrible job of the channel, but you get the idea. We don't have a lot of upside until we get to the top of the channel. There's a little bit there. And once we get to the top of the channel, I expect some profit takers will come out. Now, we're not there yet, so we could have another strong week, but I do think that market is getting a little overbought in the short term, and we need to be somewhat cautious. On the Russell 2000, we've really got a market that's lagged the overall market, and that's largely because the overall market has been led by the large cap stocks, Apple, Goldman Sachs, many of the banks. They've been leading while the rest of the market has been lagging, and you see that in the Russell 2000, which is a index of small cap stocks. Now, this past week, not the current one, but the week prior, we actually had the market break the flag pattern. We continued a little bit higher this week, and I actually think that money will start to rotate out of those large caps and into the small caps simply because they've largely been left behind. Moving along to the Canadian market, you can see that we didn't really get the pullback that we had in the US market, but we also haven't had the gains that the US market has had. The short-term chart of the TSX shows a little ascending triangle building. It's a bullish chart. We have an upward trend. The bottoms are rising from left to right, but we need to break through that 2360 level to make the next leg up. Looking at the longer term chart, we can see a pretty linear upward trend that began at the start of 2016 and has continued along. We have broken to new highs. This is a great chart. The only issue with it is that buying here, you're a little late, but individual stocks that show strength, that have good setups, good patterns, are not going to be hindered by the overall market unless the long-term upward trend on the overall market is broken. So this is a bullish market. The TSX Venture, of course, broke the pullback a couple of months ago, and it's been marching higher. It's now back to the highs from last summer, where it should stall briefly anyway, but this is a positive chart, just short term, probably going to get stuck and not see considerable upside. But keep in mind that the TSX Venture is largely a alpha market. There's individual stocks in that market that can do well because they have an exciting story. So as long as the trend is basically up, which it is for the TSX Venture, individual stocks in this market should be able to do well. It just comes down to whether the market takes an interest in their story. All right, next up is the TLT, which of course is the 20-year Treasury bond fund, a good proxy for what the US bond market is doing. And you can see it had a fairly neutral week. It is still below the downward trend line. We have seen a little attempt at a rally in bonds, but then the sellers come in and take it down. So we're not really getting an indication that interest rates are going any lower. We're kind of stuck in this sideways range here, and therefore I would call this a neutral to somewhat negative chart. On the US dollar, we tried to break a pullback this week. You can see that intra-week we had a little bit of a rally, but it kind of failed and fizzled out by the end of the week. I do think the US dollar is more likely to go higher than lower in the weeks ahead, but we don't really see that sign of life yet that breaks the pullback that has been underway for about 6 or 7 weeks. So I would say it's a neutral to slightly optimistic chart. On the gold, we have seen it rally nicely. It is now getting closer and closer to that long-term downward trend line that I've talked about many times. And I haven't drawn that very well again, but the market has had a great bounce off of support, but it's coming into a lot of pessimism. And so I caution people about taking new positions in gold. I think that if you have a position in gold, there's no reason to sell it, but I would dance close to the exit door. Oil is really a choppy sideways trading market with not a lot of action, easy to get whipsawed in and out of positions here. I just think that there's nothing to see here, as they say, and therefore it's a market that I wouldn't really be too excited about entering with the oil stocks unless we get a break out of this pattern, which is getting to be more and more narrow in terms of volatility. You can see that the volatility is compressing. So eventually we're going to get a break one way or the other, but we need to wait for that break to tell us what the market wants to do next. And finally, the fear chart. This is the VIX, and you can see we have these little rallies every once in a while in the VIX. We had one even this week, but all they really do is take the VIX up to that long-term downward trend line. And until they break it to the upside, I just don't see any fear in the market, any concern about a correction, but it could happen any day. So this is always a good chart to keep an eye on. All right, so my ratings: bullish on both US and Canadian stocks, neutral on gold, neutral on oil. US stock indexes are showing good strength, led by the big companies that have a heavy weighting in the indexes, but many stocks lag the indexes and are now just starting to come alive. So we could see a rotation out of those leaders and into the forgotten stocks. Canadian markets, the Canadian market trend is up, but with much less enthusiasm than we see in the US, which is not a bad thing. It means also less emotion. Oil remains stuck in a choppy range. I recommend caution there. Gold stalling at resistance. You want to be careful about some profit taking coming in. And basically, there's no fear in the market. All right, so here is a stock that was a good trader on Friday. This is Unilever. You can see the big gap up, the move from Thursday's close, which is down here, up to Friday's open. That's a big price gap. And that was because there was significant positive fundamental change that got investors excited and were willing to pay more, dramatically more, than they had been willing to pay the previous day. Now, what I talked about at the top of today's presentation is waiting for the stock to build a base. So you can see some sideways trading action that went into 11 o'clock Eastern time. That's an hour and a half. And in fact, took even longer until it could finally break through to new highs for the day. And that was our entry signal when it broke to a new high of the day, moved up above the open. Out of this rectangle consolidation pattern, you buy it where I've circled with support at the yellow line, and the stock ended up doing a almost 6-to-1 reward for risk before coming back a little bit into the close. So that is a good day trade, waiting for a base after a big gap, something that works quite well with gaps. I don't recommend you ever rush in. You know, many people might have said, well, I'm going to buy it here with this sign of life. That's a risky strategy because the stock hasn't built a base to build off of yet. There's too much potential for profit taking. Well, that has been the Stock Scores Market Minutes. Please like the video if you liked it. Subscribe to the channel if you'd like to see more videos from me. And most importantly, trade well.